feel like a
Hate that voice.
professor.
Yo, I'll never forget that voice.
Yeah.
Like, when I'm 80 years old, all I'm gonna in my dreams gonna hear this meeting is being recorded.
All right. Hello, hello. Welcome to episode 28 of the Golden Question podcast. We have our guest, Mr. Rosenrauch. I like calling him that because it it induces a sense of respect. Introduce yourself, Ethan.
I was already on. They should know who I am.
They
But
should
my
already know.
my question to you is, are you really at episode 28?
I've done 28. Is that too many or too little?
I don't know. I lost count. I didn't realize you were that deep.
Yeah. You know, another thing is I'm not really consistent in the timing. And I feel like that's a good thing because it's like, oh, this, he's talking a lot this episode. I'll see what it is. And then some episodes are really, really short, like only a couple minutes, especially my 2 episodes ago. I think it was like 3 minutes. And that one was scripted because I just had some ideas going. And then I was like, let me just bullet point these and then I'll read them out loud. But then I was like, you know what? Let me just script the whole thing. All right. So today we're going to be asking and answering what is the ideal banking system? And that is in reference to what an ideal banking system would look like under a free market, right? Under capitalism, under Adam Smith's vision of a non interventionist economy. So we're going to keep it simple. This is basic. Any beginner, any layman could understand.
Kiss.
What is that?
Kiss.
What is KISS?
Keep it simple, stupid.
Keep it simple, stupid. So yeah, we're gonna just talk in layman terms. Anybody should understand, and I think that's what every economist should do, is that they should try to talk in basic levels, because who's part of the economy? It's mostly just average, your average Joe. And
Didn't
what
we
a
talk
lot
about
of
weeks ago about specifically academics and economists consistently change their words so that it sounds like they're smart?
yeah, well, it does. They do it to sound smart, but they also do it, in my opinion, to make sure you're not fully informed, to keep you ignorant,
Probably, yeah.
to keep you from
So
actually
that you don't
going in
even
and
understand
researching.
that they're making false predictions.
Yeah. And this has a lot to do with Keynesian economics. What we were learned in, what class did we take? Eco, the beginning of Eco?
Sure.
What number is that? Eco 1000 something?
Which
Whatever.
one, Mac or micro?
I think it's macro. Where we talked about the Federal Reserve, we had the whole introductory thing.
Two.
Was that macro or micro?
Macro.
Macro, yeah. So almost every college, with the exception of, I guess, a few, I'm not sure which ones are the exception, but most, especially obviously public colleges that get their funding from the federal government, they teach us the Keynesian economics, the Keynesian view, which is essentially demand side economics. They put an emphasis on demand. They think demand is what drives the economy. So when they see a recession, when they see a correction in the market, their first instinct is, how can we generate demand? And how do they generate demand, Ethan? Again, we're keeping this layman terms. I'm not asking any trick questions. How do you think a Keynesian would reply to a recession by increasing demand? Stimulus, right? Exactly. What he wants is the federal government to come in and be the person to help keep prices up, to bid up prices, to help substitute for the lack of demand in the economy. So when demand falls flat, the federal government should come in and make sure demand is up. That's Keynesian economics. And then you have the Austrian school of economics, which is the traditional view. This is what was the conventional view before Keynesian, before Maynard Keynes. It was the Austrian school of economics. This is the person who wrote, damn it, I forgot his name already.
Peter Schiff.
No, Peter Schiff wasn't alive during this time. So
Schiff got in trouble a couple days ago.
What is that?
I think Peter Schiff got in trouble a couple days ago.
Yeah, because the Australian that Australian news the Australian 60 Minutes just like they scammed him.
They scammed him or he scammed them?
How did he scam them? They scammed him.
I
They
just,
went up to him.
no, I didn't watch it.
You gotta watch it. They went up to him. They told him, "Can we do an interview about gold and about gold and silver and foreign markets?" And then he said, "Sure." And then right when the interview started, they started asking him questions about his bank. And thanks for bringing that up because this is exactly why I wanted to do this. Because in my opinion, I think that the bank that Shiv has, I forgot what it's called, Euro Pacific Capital, the actual Euro Pacific Bank, his bank is what I would consider the true ideal bank that we would have in a free market. And we'll get into that. But what's this guy's name? He wrote the book Serfdom. Something about serfdom. What was the title of it?
No clue.
Serfdom. Oh, this is really
You have
embarrassing. I should know this. Oh, the Road to Serfdom by Hayek. So he's like a
Okay.
big Austrian economist. There's a
Yeah, I heard
couple, yeah. There's a
that.
couple.
Hayek also.
Frederick Hayek, yeah. So there was a couple during his time. That was the conventional view, and it was, in my opinion, the right view before it was changed by this whole wave of um, Keynesian thought. And obviously, the more conservative view, the traditional view, was supply is what drives the economy. If the economy goes into recession, the economy goes down. You need to bring supply into the economy, and supply is what's lacking um, during times of a recession. So they have a completely different outlook. They believe that supply is what drives the economy. Supply is what drives demand. Keynesians say no, demand is the be all end all. Demand drives supply. And obviously, from my perspective, it makes total sense to me that supply drives demand because what does demand do? Demand bids on the supply that's already there. So there has to be supply in the economy first for you to demand that supply and for you to ask for a
Not in this
price.
day and age.
What is that?
Not in this today's environment.
How so?
Because we have like just in time inventory. Even most of the things people buy don't most of the time they don't even exist yet.
Right. But don't when I say supply, I'm not just talking about inventory. I'm not just talking about raw goods. I'm talking about the capital, the savings behind the production. The supply is considered, all the labors of production, the capital, the factories, and the goods, not just the goods. So yes, today some people buy something before it even comes out, but in order for them to buy it, there needs to be somebody with a lot of money who's willing to produce the thing, or there needs to be a factory already set in place to actually produce the things. All those things are considered in the sector of supply in the economy. So when Austrians, when conservatives in the economic school of thoughts, when they reference supply, they're not only talking about the actual goods. It's all the factors of production: land, capital, and labor. Also labor. Yeah, I forgot to mention labor. Even the people working, you have to have already people willing to work for you before you can ask for people to demand your goods and services. So, do you see any objections to that? Is there any? Does it sound at
It
least
sounds correct, but it's
plausible?
dated. Sure, it's dated.
You think it's dated? Okay. So let's quickly look at um, what happened before the Federal Reserve. Obviously, what do we taught happened before the Federal Reserve? There was a lot of. Why did I write Fed banks here? All right. So what happened before the Federal Reserve? What does the Federal Reserve tell you about its creation? Like, why did it come up into being? What do we taught, Ethan?
To prevent catastrophe, to promote
But what?
stability.
Yeah, but what was the catastrophes that were occurring at the time?
Depression.
Well, before, yeah,
No,
what did
before,
they say caused the depression?
wasn't
Before
it
the
before?
depression, yeah, the Federal Reserve was created in 1913. What a coincidence, right? The Federal Reserve was created in 1913, and then we had the depression in 29. So, what? Why did the Federal Reserve come into being in 1913? What do they tell us?
You tell me, you're the lecturer.
I'll give you a hint. Run.
Oh, bank runs.
Bank runs, exactly. So
But wait, but now I'm confused because in the Depression they had bank runs, didn't they?
yes.
So how does this make any
Well,
sense?
the way that the Federal Reserve works, like the whole FOMC, the meetings and everything, that was created after the Federal Reserve, um, Federal
Okay.
Reserve Act of 1913. Yeah, but and again, the Great Depression, there were bank runs, but what prevented the banks from actually going bust? Do you remember?
DIC.
FDIC, yeah. So that's again, that's separate than the Federal Reserve, but that's you could lump that in all during that era. But it was basically it was mainly the FDIC that they created um, during the Great Depression. And what honestly, what happens there is the federal government now has close ties with the Federal Reserve because remember the Federal Reserve is still technically a private company. And when it was created in 1913, it was supposed to be this private company. It was supposed to be isolated from the federal government. It was not supposed to be influenced by the federal government. But right away, when you create something like the FDIC, you create a sort of link there, right? That the federal government now, with the help of the Treasury, has to supply these banks. There has to be a federal approval, right? What does FDIC stand for? Federal, and pop it up here,
Federal da, 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 Commission.
something like that. Yeah, Federal Deposit Insurance Corporation. Oh, it's not a commission; it's a corporation. But look, it's an independent agency created by the U.S. Congress. So again, it's yes, it's still an independent company. It's sort of like an independent private company, but again, it has strong ties with the federal government.
Imagine how crazy you realize how crazy that sounds though.
What?
That there's one corporation that guarantees the deposits of 400 million Americans.
Yeah. Well,
How's that
here,
possible?
yeah, and here's the another weird thing to think
That sounds
about.
like a catch.
Here's another thing to think about. Corporations originally, do you remember who the first corporations were? Or
I
what the
mean,
well, I think there is a single first corporation that's recorded in history. Do you know what that is?
what time frame are you considering?
The entire everything, the entire timeline. What's the
The
first
Rockefeller?
recorded corporation? Would you say
I said like the Rockefellers.
before the Rockefellers?
I don't know. The
The
printing press.
East, the British East Indian Company.
Oh, okay.
That was, and it was a government corporation. So it was a corporate. It was like a quasi-private slash government-owned corporation. So
And and to this day they still play cricket.
yeah, but the reason why I brought that up is this idea of corporations is not native to, in my opinion, capitalism. I think in a capitalist society there are no such thing as corporations because it's very hard for a business to reach that level of revenue, that size that the corporations we see today. The only reason why we see corporations today is because again there's with the entire banking system that we have today, the entire economic system that we have today, it enables these companies, these small businesses, right? All these corporations were small businesses at one point because of the situations we're in. It has enabled them to become corporations. But again, in a true capitalist society, there isn't supposed to be these big, massive corporations raking in trillions in revenue or something like that. This is, again, a creation of, as a result of the government intervention in the economy, this mixed economy that they talk about, that Keynesians talk about, right? They like a mixed economy. They don't want complete free market. They think that there should be government intervening. And what are the side effects of that? Well, you get distortions in the market. You get, I like to look at it as warps. So let me just bring my notes back. So we had a series of bank runs prior to the Federal Reserve. Now, I think the Fed blows it up out of proportion, obviously, because they need to point that as a problem to so that they can solve. So they try to blow up the problem and claim, hey, we fixed this massive problem that we were having. So there were a couple of bank runs. Nobody's going to deny that. And so, can you just quickly run down what would happen? What happens in a bank run, Ethan? Just like 2 sentences. What
Everybody comes to withdraw their money.
exactly? And what happens when they come to withdraw their money?
There is no money.
Exactly. So the people come to withdraw their money. But first, why do they go withdraw their money? Like, what prompts?
They're losing confidence in the system.
Right. So well, again, it always starts off with somebody, right? There's always one person. Kind of like, it's not related, but when I speak of bubbles, there's always one person who realizes he's in a bubble, but he doesn't want to tell anybody else, so he just keeps hush hush and secretly tries to sell his stuff while the bubble is still inflated. But it always starts with one person. Same thing with this idea with the bank run. It's always one person who says, "Wait a second, I don't think the bank has all these deposits that we're putting in." And he tells another person, and then it ends up being like just a huge swath of people that say, you know what, we want our money. And obviously the bank can't, what's the right word? Can't recover all of their deposits. They can only give out some. Now, why is that, Ethan? Why doesn't the bank have the deposits? I mean, look, the people go to the bank to store their money, right? Why wouldn't the bank hold the money? Exactly. They're loaning it. They're issuing debt, essentially. They're issuing credit. And so all these people that gave the money to the bank, they're essentially creditors, right? They're essentially creditors to the bank. They're not actually
making any return.
What is that?
Except they don't make any return in this day of age.
Well, no, all right, yeah. They don't make any return this day and age. But look, back then you had people who credited money to the bank. They became creditors. And then the bank loaned out money. And then let's say the bank made, a 10% interest on the loan, then it would give like 1% to the creditor, right? So and then the bank would rake in the profits there. And obviously this is all with both cash and gold. There were some people that had some gold, and then there were some people that had some cash. But I would argue the bank mostly loaned out a lot of the cash reserves that they had, not the gold reserves. So this is what we call a fractional reserve banking. You've heard the term before, right, Ethan? Fractional reserve banking?
Yes.
Yeah. So fractional reserve banking, what does that mean? The bank keeps a fraction of your reserves and then the rest are loaned out. And obviously the bank in this case is participating in the creation of debt. Now, this is where we have to get a little bit philosophical. And that is, I believe that debt is a sin. Why is it a sin? I've explained numerous times, right? When you consume debt, you obviously, again, there's obviously interest attached to it, so you end up paying more, and it prohibits and discourages savings, which is, again, very vital in an economy, especially since I consider myself an Austrian economist. Although, again, I don't agree with 100% of the Austrian ideology, because Austrians ultimately they think that, hey, debt could be used in the economy, but it could be used in a good way. That's where I differentiate myself from them. I think that debt should be completely prohibited, not prohibited in the sense that the government should make a law banning debt, but it should be discouraged. People should try as hard as they can to avoid debt.
You know that there's plenty of people who think that the proper way to build the business is 100% debt.
Exactly. So that's the mentality that we have right now. That's the corrupt mentality that we have, where, right, initially debt was, I mean, for all of human history, debt was seen as something bad, right? This idea that you went to go borrow money meant that you were desperate.
To be honest, though, coming from a finance perspective,
yeah,
debt is cheaper than equity. That's the reason that's their justification for it.
Right. And I've talked about why businesses shouldn't use debt to gain capital and to expand. And I guess we could talk a little bit about that now, but I've made several episodes.
But it does make some people super rich, though.
What is that?
But the part you're missing is that it does help certain individuals become really rich.
It helps individuals. First of all, I would argue it doesn't help individuals. And yes, some individuals happen to get lucky and they end up benefiting from it. Yes.
Look at Bezos.
Obviously, yeah.
Look at all those characters. All their businesses are built on debt.
Exactly. And again, I've also made another episode about why I think Amazon is really a
So that
byproduct of the problems we have in our economy with the trade deficits. But that's besides the point. I don't want to get into a bunch of tangents. So, in an ideal free market, my view is that debt is something that is avoided, and it is something harmful to the economy. And I've made several episodes talking into different aspects of why debt is bad in terms of um, businesses raising capital, why it's bad for individuals, why it's bad for the overall economy. I've made several episodes talking about how debt is bad in each different aspect of the economy. So just again, I'm keeping it simple. In a capital society, debt is bad. So this idea of a fractional reserve banking doesn't make any sense because first of all, you have people who, in again my view of an ideal economy, people use precious metals, right? There is cash receipts circulating, but those cash receipts are backed by the precious metal that somebody has. So, in again, in my view, and the view that we've seen prior to the Federal Reserve, banks issued their own currency. So they held reserves for gold, and again, banks held their own reserves for gold, and then they issued currency that was backed by that gold. And each bank had their own currency. I think after the Civil War, that's when the federal government really started to mandate people use this centralized currency rather than this individual bank currencies. And so when you have people who go to the bank to deposit their precious metal, to deposit, let's say, their ounce of gold, obviously in that sense, when somebody goes to a bank to deposit a precious metal, it's very hard to loan out that precious metal because again, that precious metal is in it, it's contained in a certain size, and obviously the bank can't just chop it up and then start loaning it out, right? It can't just start cutting up your piece of gold and then saying, hey, I'm only going to hold a portion of it. So first of all, logistically, I don't think this idea where a bank can only hold a certain amount of your actual precious metal holding in its reserves, I don't think it's possible. But let's say it is. Let's say a bank says, you know what, we want to allow our creditors, to allow our depositors who deposit money into our accounts, we want them to have a return. What would you consider that entity, Ethan? What would you name that entity? Some entity that says, you know what, people who give us money, we're going to give you a return. What would be the classification of that entity?
an investor.
Well, yeah, exactly. So in that sense, when you have an institution that says, hey, give us your money, we're going to give you a return back, it's no longer a bank. It's considered an
That's what
investment. But look, exactly. But I'm making a distinction here. I'm making a distinction.
You're considering it as more of just a firm, not a bank.
Exactly. I'm making a distinction that what we have today and what this idea where you go to a bank, they hold a fraction of your money and then they loan out the rest and then they give you a return. For me, in an ideal economy, that's not considered a bank. That's just considered a financial institution. That's just considered an investment, or you can even call it an investment bank, right? And we even have, you see, that's the problem with today, is that you have investment banks, but then you realize that there's really no difference between an investment bank and Chase, because both of them invest your
No,
deposit. It's just,
that's not what investment banks do.
so what do investments banks do?
They just give advice and take companies to market.
Exactly,
Public.
but you could also have an
They're
account with that investment.
basically.
Yeah, I know that's a separate thing that it does, but you could have an account in your investment bank. There's one. There's I forgot the name of it, but there's one on Richmond Avenue right in front of the old Barnes Noble. That's considered an investment bank. They have the sign out, and it looks like a regular bank. You could walk in. They have checking, savings accounts. There's an ATM machine outside. Why is that?
Some of them have like brokerage houses as like a side business.
Yeah, and every other bank has that too. Chase offers you your own brokerage account and you know, your own investing account. So what's the difference between the banks that claim to be investment banks and your traditional bank? I would argue there is no difference. The difference
I
has
mean, there's
been
supposed to be a difference,
removed.
isn't it? Don't they have to be different by law? I think
The only difference is the difference that you stated, which is
they're
that
not allowed to be
one.
owned.
What is that?
I think they're like not allowed to be owned by the same companies. Like they
I
split them.
Yeah, but I think that the what you said was, I think that's a big difference. That's the only difference that I could think of. I mean, yeah, there's probably other differences, but I think the difference that you said with helping startup companies, like the I don't even know the correct term.
They take companies public.
Yeah, they take companies public. That's something that you could say, all right, that's what an investment bank does. I mean, if you search up the definition for investment bank, that's what'll pop up. Investment bank. Yeah, it underwrites new debt and equities for securities for all types of corporations. Yes. So let's try to get rid of some of the terminology here. But for me, a bank that says, hey, we're going to hold your money, but we're only going to hold a portion of it. We're going to loan out the rest and we're going to give you a return. That to me is not a bank. That's just an investing institution. That's just a financial institution that's promising me a
But what do
return
you
for
consider a bank? A place that just holds your money for you?
exactly. So that's where the difference occurs. A bank for most of human history,
But then how are
and
they supposed to
for,
make money?
I'll explain. A bank for most of human history and in an ideal free market purely holds your money, right? I mean, I could be wrong, but I think the verb bank came from the idea where you store something, right? You bank something means you store it. That's all it is. It doesn't, it's, there was no connotation of a return associated with it. It was just you store it. Rather than me storing it in my house, I can store it in this facility that has better,
I think by
obviously more
human nature,
space.
you might be wrong.
What is that?
I think just if you consider human nature, what you're saying is probably wrong. Because what person in their right mind would say, "I'll hold your money for free"?
But listen, I didn't get. There's going to be fees associated with it, of course, right? Obviously, you can't. They're providing you a service that is holding your money and providing you with security. There's obviously a facility there that you would normally have to pay rent for. There's obviously security guards that you would normally, if you were to store it yourself, you would have to pay security guards. They're providing you with that security. There's security cameras, and maybe there's even insurance involved in there. So the bank offers you that service, and then you pay a fee. So
Okay.
this is how a traditional bank has worked for most of human history, right? The idea of bank obviously is not anything new. Banks have existed in the past. It's just that banks now are doing things much more different than they have in the past. And what do they do in the past? They simply held your, in this case, it was mostly gold. For most of human history, people actually had physical precious metals that they would hold in the bank. And so what happened during the early 1700s, during the early 1800s. And again, there was parts where it happened before then, but mostly during the 17 and 1800s, I always get the centuries confused, 18th and 19th century, is that banks said, you know what? You can use your gold even though it's stored here. We're going to stockpile it, and we're going to combine everybody else's deposits. So you have an ounce of gold, you have 2 ounces, you have 3 ounces, you have 4 ounces. So let's say we pile it all up, we put it all together, and this is the beauty of gold, is that it's fungible, right? You could melt it and combine it with somebody else's, and then if they request it, you could just split it and give it back to them. It's fungible, and that obviously there's a lot of other characteristics involved there. But what the bank would do is they would take all your golds, they would smelt it down, and then they would give you a receipt that says, hey, this is tied to your gold holding or your precious metal holding if you didn't have gold. And then that person could go around with that receipt, and that receipt is tied to that bank, and then they would go and buy things with it. Here I have money stored in that bank. Now you might ask me, Ethan, wait a second, how do I know the gold is in that bank? How do I know that there is no gold in that bank? Well, that's part of now the bank's reputation. It's going to be part of their reputation to make sure that people have trust that all the gold is being kept in a secure facility. So it's in every incentive for the bank to make sure that 100% of your deposit stays in the bank. Because then if your deposit leaves the bank, then that defeats the whole purpose. Because then now my receipt, if I were to tell somebody, here, I have 100 ounces of gold in my bank, here's the receipt, you can go pick it up. And then the bank could say, oh, well, we only have 80 ounces. So this fractional reserve banking, obviously in this scenario, doesn't make any sense. It's in the bank's every interest to make sure they have 100% of your gold, of your precious metal holding in its bank. And what's the bank's duties? What's the bank's role? Is to secure it. That's the only thing that they have to do. And then you pay the bank a fee. Now, why did we go away from the system? Again, this was the status quo at one point. Why did we go away from this? Well,
so that can make money.
Well, the bank was already making money before, as I said, from the fees.
More money.
All right. Well, you could look at it that way. I would say a couple things happened. First of all, you've had people starting to use receipts more often. I think people started to use receipts more often, and people forgot about the gold backing. They forgot about the gold. They just started to transact with the receipts. And so the banks, most of the times, were actually holding receipts of deposits of gold in other banks. So let's say I have a receipt from one bank, right? Let's say I have a receipt from Chase Bank. This receipt says, hey, there is 100 ounces of gold at Chase Bank. Here's the password. Here's the code. You can go pick it up, right? Now, what I would do with that receipt is, let's say I have a couple of them stockpiled. I would say, you know what, let me go ahead and store these receipts in another bank. And so that person would take those piled up receipts and take them to another bank. And so eventually people forgot about the actual physical precious metal. They just started transacting the receipts. Now, initially, there's nothing wrong with that, obviously, right? There's nothing wrong with that. But obviously, once after the Civil War, once the federal government said, you know what, we need to have a centralized currency, a centralized, issuance of currency, then the federal government said, you know what, we're going to scrap this whole banking system. We're going to take all the gold that's piled up in all these different banks, and we're going to put them under, the central bank of the Federal Reserve. We're going to take everybody's gold holdings in all these individual private banks, and we're going to pile them in, and we're going to keep them with the Federal Reserve. And then currency would be issued, as always, but this is obviously everybody's using the same currency now. And then that currency obviously was linked to the gold holdings of the Federal Reserve. Now, obviously, this is a problem right away, because I would argue, wait a second, now you're letting the government store and provide these services that a normal private bank would. So you're essentially in this. So just to quickly recap, we've had individual banks storing your own gold, storing your own precious metals. The banks issued its own currency that is backed by that gold, backed by that precious metal, and then you could transact in it. Then after the Civil War, and then in the Federal Reserve 1913, it was basically set in stone that the federal government, with this quasi-private institution, it is going to control currency. It is going to issue currency, and it's going to hold your gold and your silver. Now, there's still debate going on in which, wait a second, if there is currency being issued by individual banks, how is the idea with taxes going to be, how is that going to be dealt with? Did that issue come up, Ethan? I thought you would bring it up. Like, hey, if banks are issuing their own currency, how the hell do you pay taxes?
My internet went out. I didn't hear anything you said in the past minute.
Yeah, I figured because it went mute. All right, so what was the last thing you heard?
I don't know. When you stopped talking, and then I was like, why do you stop talking? So, and then I realized the internet went out.
All right, so just to recap, we've went from banks holding your precious metals, issuing currency based on that on your holdings, people transacting with those receipts, with the trust that the bank does actually have your receipts. Now, let's say, Ethan, let's say you presented me with the receipt from, let's say, Chase Bank, which had your gold holdings, and you know what? I didn't trust Chase Bank. Well, I wouldn't accept your currency. And then you would say, all right, what bank do you actually trust? And then from there we could, the reputation of banks could emerge. So we went from that system to a system where, after the Civil War and after the Federal Reserve Act, where the federal government in coalition with the Federal Reserve said, you know what, we're going to control currency, we're going to control the holdings of your precious metals. Now, obviously, you might have raised the problem, which is, again, still being debated till this day, and that is, how does tax collection work? How is the government going to tax you? Is it going to tax you on your actual? Is it going to can you pay your taxes via the receipts? Right. Well, if you can pay your taxes via the receipts, then what if your receipt is, what if the bank doesn't actually, let's say, have your precious metal holding? Let's say something happened, they lost a little bit, but you already paid your taxes with that receipt. Now what if the government wants to then cash in that receipt, and then they find out that the bank doesn't have the actual holdings? So that was an issue, right? If we have these individual banks issuing their own currency, how in the world is the government going to collect taxes? Well, the government is going to collect taxes, but it's only going to collect taxes via your actual precious metal holdings. It's only going to collect taxes in gold and silver. And that, again, I think it's written down in an article in the Constitution where the government is going to collect taxes, and it's going to, the only form of revenue it's going to accept, the only form of taxes it's going to accept is gold and silver. So that's actually written in the Constitution. So right there, I think that issue, again, people still debate, well, then the federal government would have, some person would have to transport their gold to, the federal government, and then somebody could say, hey, that's why we instituted a federal post office, right, for people to be able to pay for their taxes. Let's say they can't afford to transport documents via a private post office. The federal government's going to issue one to sort of standardize everything. So you could make the argument, hey, that's an argument for the post office, and that's why the government should accept taxes in gold and silver, and then you could just ship your gold and silver to, the U.S. Treasury via USPS. So now you might ask, Ethan, what's the problem here, right? What's the problem with fractional reserve banking and the fractional reserve banking we have today? Well, first issue is, banks are no longer held accountable for their losses in your investments, right? So if a bank, and this is especially true with the creation of the FDIC, right? Back then, banks had to prove that they were, even the banks that were investing your money, not the banks that just held 100% of your savings, the banks that practiced fractional reserve, the banks that actually invested your money. Again, I wouldn't consider it a bank. I would consider it just as an investing institution, or just your a financial institution. I wouldn't consider it a bank. So you've had these investment banks in the past who people would go deposit their money, the bank would invest, and then you were promised a return. The problem is, those banks started going bust. Obviously, there's a bank isn't going to make the right investments every single time. There's going to be areas where it makes a bad investment, and it loses some money. And guess what? It loses even some of the principal of the depositor. So now the bank says, what are we going to do, right? So there's obviously going to be bank runs, yes, in the sense that if you give your money to someone expecting them to invest it, there's a level of risk there. So that's an argument for why these bank runs started to happen, right? It's because of this fractional reserve banking, and a lot of these investment banks started coming out and saying, "Hey, we're just a regular bank." And what we saw was this sort of normalization of investment banking. And your old traditional banks, which just held your reserves like any traditional bank, and you paid a fee, those banks were sort of going out extinct because, again, more and more people were getting comfortable with the idea of, hey, my bank is going to make some investments for me, right? I don't need to actually put my money into a bank and pay a fee. Why would I pay a fee to a bank for it to hold my money? Meanwhile, another bank claims it holds my money, claims it makes good investments, and they pay me, right? They pay me a return. Technically, they call it interest. So right away, again, you've sort of left the banking realm, and now you're no longer, in my view, considered a bank. You're considered an investment, quote unquote, bank. You're considered an investment institution. Now, obviously, with any investment institution, if you put money in and then they promise to invest your money and then they lose, sometimes they can dig into your own losses. Sometimes they could lose the money on your investments, and then suddenly you're down on what you deposited. You gave somebody $100 and told them, hey, go invest it for me. They can come back and say, hey, we've lost on the investment, and your $100 is gone. Now, intrinsically, there's nothing wrong with that. Obviously, it's just this institution made a bad investment. But because so many people are accustomed to this new banking model, again, I don't even consider it a banking model, but this new model of banking, more and more people are now inheriting all the risks associated with that. So now every single person, even your average, your regular minimum wage guy who makes a couple bucks and then he puts it into his bank, he thinks that, hey, my bank is gonna hold my money. Well, Ethan, you still there? Your internet went out, Ethan? Hello?
Hello?
Did your internet go out again?
Yep.
All right, you gotta, what's the issue?
It keeps like switching. I don't know. Fucking weird.
All right.
Chromebook.
I could tell when your internet goes off because it mutes you. All right. So let me just finish what I was saying.
Very nice.
What is that?
Said very nice.
What does that mean?
Very nice.
Oh, okay. So you had your average guy making his daily wages, and then he goes to a bank thinking that the bank holds his reserves, 100% of it, and then the bank does an investment, does investments on his behalf, and then you had a couple of banks making bad investments, and the people lose money, and again, rightfully so, because you're a creditor to the bank now. That bank is now investing your money, and if they make malinvestments, if they make bad investments, you're going to lose money without a doubt. So the federal government comes in and says, you know what, this is not fair for these people to think that they're putting money into a bank, and that the bank is technically saying that it's going to make safe investments, and it's advertising as if it's a bank, right? Where again, people at that time, you had the mentality, hey, a bank holds 100% of my reserve. But banks at the time advertised, these financial institutions which invested your money advertised themselves as banks. Hey, come put your money, we're as good as a bank, right? Where you're guaranteed, at least you won't lose your principal. Well, you could pocket your savings with us, and we can guarantee that you won't, we'll make investments on your behalf, but your investments will never lose value to the point where it digs into your principal. So obviously you had a couple banks that advertised themselves as banks, and who knows, the federal government could have intervened in some fashion that I still haven't researched, but a lot of people lost their money. The federal government came and said, you know what, it's not fair that these people are losing their money with these banks, so we're going to issue, we're going to have the FDIC, which is the bank. The federal government now says, you know what, we're going to ensure 100% of what you put. Obviously, there's a minimum. What's the
It's
minimum? I'm
200,000.
sorry, maximum 200,000.
200.
Yeah, yeah. So what does that do now? Now it just pretty much shields the banks from any credibility, any accountability for how they invest your money. It doesn't matter to them whether or not you know they actually make good sound investments with your money. To them it doesn't matter, right? If they make a bad investment and their 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 reserves get depleted and all these people come running asking for money, the federal government's got them. The federal government makes up the difference. So what that did right then and there is it sort of removed a level of risk involved with people. So now people said, you know what, these banks are essentially all the same. I'm just going to put my money in there, and heck, they're going to promise me a return. I'm guaranteed not to lose my money. Heck, it's the safest investment I can make. So, right, again, back then, people, when you went to go apply for a bank, you actually had to look at their balance sheet. You had to actually look at their, just as if you're investing in any business, because technically, when you're putting your money into a bank, you're somehow some way investing into the bank. People today, obviously, and ever since the FDIC, people don't care about where they put their money into the bank, and the bank now doesn't advertise that it makes sound investments. So, and this is really, I think, what happens with a lot of malinvestments, right? This whole idea of malinvestments happening in the economy, where you have a lot of companies that shouldn't have investors that all of a sudden do. And mainly, you have a lot of what they call them zombie companies, unicorn companies. Again, this is back in the day also, but it's more prevalent today than it has ever been. You have a lot of companies that don't make any profits, but yet somehow people are still investing into them. And what you find out is that it's a lot of banks that invest into them. And where do these banks get the money? Well, first of all, they're getting it from all their debtors, all their creditors, all their depositors that deposit money into their banks. But now they're not held accountable for the investments they make. They can make any investment they want. It doesn't matter if they make a loss or they make a win, because at the end of the day, their depositors are going to still keep depositing money into their bank, and the federal government's got them insured. So right there's what they call a moral hazard that was instituted. Also, add in this idea of the Federal Reserve now filling up the reserves of these banks, right? The whole FOMC, this whole Keynesian interventionist idea in which the federal government says, you know what, or the Federal Reserve, excuse me, says, we're going to fill up the reserves of these banks. If you work for the Federal Reserve, we're going to fill your reserves up for you. And if you're not a part of the banking system, the Federal Reserve will offer you some cash at a really, really low rate, at a really favorable rate. And then you could pay us back in the future at this favorable rate. So this whole fractional reserve banking model, in my opinion, is what induced a lot of the problems we see today. And so the reason why I got the idea for this video is Peter Schiff's own bank, his Euro Pacific Bank, actually is what I would consider an ideal bank in a free market. He does not make any loans. His bank does not issue any debt. All his bank does is say, hey, you know what, store your money with us, and we'll offer you, you'll have to pay us a fee for, holding your money. And again, today's bank do more than just security. They offer you the ease, they offer you an app, they offer you customer service, they offer you a bunch of other services. So the fees, again, make sense in that regard. And so this also leads into this idea of debt, right? Because if you got rid of the fractional reserve banking, if we just went back to a system where you had banks that hold 100% of your reserves, there is no room for debt. You cannot issue debt. The whole idea of debt gets removed. Now you might say, wait a second, what about if I go to these quote unquote investment banks and I make deposits and they give it out? Isn't that considered debt? I would say no. I would just consider that a capital investment, because the bank is making investments with your money. It's giving it out to other people. And second of all, the return that you're provided isn't considered interest. I would consider it just as a return. Now, again, some people use the term interest and return interchangeably, but I would argue interest is exclusive to just debt. It's exclusive to just the a person giving you money and you paying him back with interest. And obviously, there's the time value of money. And this is where I disagree with Austrians because again, they believe in all this, but I don't. So there's a difference between that, and there's a difference, and then there's return, which again, you're making a capital investment. You're giving somebody money. They're doing stuff with your money. You have a stake in that business, right? You technically buy up shares, or you buy up assets, or you participate in the management, or you participate in the ownership. So you have an actual stake in the company, and then the company gives you back a return. So it's not like you're just giving your money to a business, right? When you invest, you're not just giving your money to a business and then you just sit back and wait for them to give it back to you. No, when you invest, you actually buy up assets. You actually either buy up assets or you have a portion of the ownership of this business or this company that you're investing in, right? Anybody who invests in the stock market, you own a share of that company. You actually own a portion of that company. Now, whether or not it's meaningful in the sense that when the company goes bankrupt, are you going to get anything? That's another question. But the idea is when you invest, you're not just simply giving money to the business and you're not getting anything in return right away. There is a plurality there where you give money to a bank right away, then right then and there, the bank provides you with their assets. It provides you with a portion of their assets, a portion of the ownership of the business, and that is okay, right? That, in my opinion, is considered a good thing. That is, in God's eyes, halal. That is permissible. But what's not permissible is just giving somebody money and not taking ownership in anything that they own, not securitizing it, and then just expecting back interest. And again, another thing.
Securing.
Yeah. So securing, when you give somebody money and then you securitize it, that, in my opinion, is also considered an investment. It's not considered debt, and that return that they pay you is not considered interest. For me, interest is exclusively giving money to somebody without any stake and then just expecting them to pay you back. That, in my opinion, is what we see in the Bible and the Quran and the Torah, Old Testament, New Testament, that God prohibits, and what humans have throughout history have prohibited and have seen as a morally bad thing, as an evil thing. So when you securitize quote unquote debt, then it's no longer considered debt. It's just considered an investment. So how does an ideal banking system look like?
What if you securitize debt?
Yeah, well, that's bad because you're securitizing something that's debt, and debt in my eyes is not permissible. It's like saying I securitized alcohol, right? It's still that, and then that's bad because then I'm securitizing something that's not good. So whatever you're securing also needs to be, permissible. Kosher, yeah. So that's my view. What do you have any questions, Ethan?
I do not.
So essentially, let me just wrap this up. How long have we been going for? I can't even see. Can you check how long we've been going for?
Half hour.
Half hour. Right, so that's good. So yeah. So quickly, let's wrap this up. Ideal banking system. A bank needs to do what a bank should do, and that is to secure your savings instead of you holding it, right? Technically, you could become your own bank and you bank your money yourself. You put it in your own house, but people would like to trust other people to hold their savings.
I have a pushback.
What is that?
Let me play devil's advocate. I have a pushback.
Yeah, go for it.
The reason that in today's financial environment that banks have double function where they store your money and they invest it is because that's what people want.
Well, yes,
it's convenient to have your savings account linked to your Charles Schwab brokerage account.
Exactly, Ethan. I don't disagree with you, right?
Or to have them have a savings account linked to that.
Exactly. I don't disagree with you. If you, I would, you know, for me, I would keep let's say, you know, we have this ideal banking system. I would keep a portion into a traditional bank. And then who knows, I might say, you know what, I want to invest my money and I'm willing to take on the risk. But look, people today, they don't realize, and the government hasn't allowed them to realize the risk that's involved with putting your money into a bank and then your bank investing that money. Because if the bank makes bad investments with your money, you have to take the fault for it. You've entrusted that bank to make your investments. The bank F's up, you take a loss. The federal government hasn't allowed that to happen. It's gave the illusion that, hey, you could just invest for free without any risk. You could put your money into a bank, the bank makes investments, it gives you interest, and your interest is guaranteed. And this is where the idea of interest rates come from, right? It's this fixed yearly rate where you don't have to, you know, it's not like your interest rates can change over time. The bank is promising you this return yearly, and the bank does its investments. But who cares if the bank loses money? Your interest rate that the bank is promising you is still the same, because at the end of the day, if you demand your money, you could just either call up the Federal Reserve and the Federal Reserve gives you the money, or if the bank is really in having trouble, the federal government just authorizes the Fed to print the money, and it gives it. And again, I don't know exactly how the FDIC works. It's not, it does, the federal government does insure you, but I think it's still, I think the federal government technically has to then borrow money from the Federal Reserve to then give to you, and then it has to obviously pay back the Federal Reserve. So that, I think that's how the FDIC also works, but I'll have to look into it. So yes, Pete, what was your question initially, Ethan? Why do what if people want to bank their money and have the bank do investments for them, right?
Because
Well,
a lot of people just will defer to them because they believe that they're professionals.
exactly. Well,
They'll
the
do
problem
better
is
than.
the problem is they're not allowing themselves to realize the risk. Does that
What
make
do you mean?
sense? The risk,
No.
meaning if the bank makes bad investments and it loses your money. Let's say it invests it puts it into a business, or it buys up some assets of a company, and it invests, and then that company goes bust, it loses your money. So then you now have to take on that risk of losing your money in the event that the bank does a bad investment with your money. But the
So
federal government isn't allowing that to happen.
what do you mean? They
With
are.
the
What do you?
No, if the bank goes bust, the FDIC has your back. Or
Yeah. If the bank goes, I thought you just mean if the bank doesn't satisfy that return that you were expecting.
well, no, the bank just, that return is just on paper, right? It's required to give you that money, and obviously it's going to deplete it from its reserves. But first of all, it doesn't matter what's in its reserves. Even if its reserves go to zero, you're still going to get your promised return, because the FDIC has you secure. They're going to give you back 100% of your 100% of your savings. On top of that, the Federal Reserve is pouring money into the bank's reserves. So again, the bank has this endless supply of money, right? It's getting money from its depositors. Now it doesn't have to worry about losing its depositors, because there's no obligation for it to. There's no reputation at stake, right? There's always going to be depositors at the door ready to bank their money. The bank is going to promise them a return, and where's it going to get that return from? It can get it generally from its actual return on its depositors, investors. But in the event that it makes a bad investment and now that return can't be fulfilled, it could just take the money out from its reserves, which the Federal Reserve is filling up. Or let's say, it says, it puts its hands up and says, look, we don't have your reserves. The FDIC can come and insure everybody. Does that make sense?
Yes. Did you know that there's going to be an asteroid in 2068?
Is it really
Yes.
coming to Earth?
That's what they say.
Is it like a little one, or is it it's like a full
No, like a
blown
real one.
extinct?
Like a real one.
2068, end of the world. So so it's gonna happen in our lifetime.
I guess. I don't know.
We're gonna
I
witness
mean,
the end of the world.
this year is like a good warm up, and we'll live our till middle age, and you know.
I'm trying to search it up now. Asteroid coming to Earth. 2068. They call it,
A god of chaos.
yeah. It says may comfortably get close to Earth. All right, it's not going to actually hit it.
I don't know, bro.
Look, what
How
the
you think
Earth.
the dinosaurs went? You think the dinosaurs were expecting an asteroid?
All right, but look, in in the in the Quran and in the Old and New Testament, it says that Earth is going to be basically a flame, right?
Does it?
Yeah, that's
I
that's what's
never
going to
went to
happen at the end
Bible.
of the world. The end of the world is basically the Earth turns into this quasi hell, where everything's burning, people are burning, and then we go, and then essentially that's the Judgment Day, right? Where all the dead people get
Yeah.
resurrected.
No, Armageddon.
Exactly. So that's what's prophesied in the Bible and in the Torah and then later on in the Quran. Well, how do we reflect that today? I would argue, how do stars die? Right? They consume more
Explode.
and more. Exactly, they explode, but they get to a big size, and then they say eventually that the Earth is going to get engulfed in the sun. In my view, that's the prophecy right there. Is that we're gonna the end of the world is gonna the end of the Earth is pretty much going to be as planned, and we're going to live on until I think they say like millions and millions of years until the Earth gets engulfed by the sun, and then that's the eventual judgment day. So I don't believe that the Earth is going to get timeline is going to get cut short by an asteroid or anything, and I don't see
It doesn't
any
have to be
big
Earth, but it
catastrophic
could
event.
be us.
What is that?
It doesn't have to be Earth, but it could be us.
What do you mean?
Just because we all die doesn't mean Earth will get destroyed.
Right, yeah, and I don't see any catastrophic event occurring. I don't see
Okay.
any because it's not prophesized, so I don't see it occurring. If there was going to be a big thing happening before the ultimate judgment day, then it should have been stated in the text in the scripture, but it's
Coronavirus.
not. What?
Like coronavirus.
Coronavirus is not that big of a deal. Because people got it and then they get out of it. It's only if you're old and then you have pre-existing conditions and then it becomes an issue.
Say,
Yeah. So, do you have any questions, Ethan?
I do not.
Are you convinced that fractional reserve banking leads to debt, and so fractional reserve banking?
And Oddman.
Yes.
Nothing is perfect in this world.
Nothing is perfect. I agree.
That's just the environment. How else are people supposed to make money?
Exactly. But the government gives you the illusion that things are perfect.
So be it. Their downfall will come.
Your downfall will come, and hopefully it comes sooner than later, because the longer we push the outcome, the longer we kick the can down the road, the more ugly it will get.
Indeed.
Indeed, yeah. Um, we should do another episode. I want to talk about a little bit about the Great Depression and how what we're told is sort of not entirely correct. It's based on a couple of truths, but it's not entirely correct. So we could probably do another episode where how did the Great Depression really happen? And we could talk about a little bit about how the federal government and the Federal Reserve actually helped induce that Great Depression, and even even in the event that the Great Depression happened, how it wasn't actually a bad thing for individuals, and we'll talk about that next episode, and we'll see if Ethan wants to join us or if he'll be busy campaigning for or joining on a campaign with Joe Biden, because that's who he voted for.
What?
You voted for Joe Biden?
That's not supposed to be public knowledge.
Really? It doesn't
A
matter.
vote? the vote is the most private thing that an American citizen has.
Their vote. I think the most private thing is my property. Private
You own
property.
property.
Huh?
You own property.
Yeah. My iPad, my laptop, my phone. Well, technically, I
The
don't. I don't
bank owns
own.
that.
What is that? Well, the bank
Chase-
owns my iPad. Yes. Well, not really. Well, again, the bank hasn't securitized my iPad, so they don't own my iPad.
I mean, they own. You don't own all the equity in it.
I don't own all the equity. Well, but listen, that's the problem. This is what when we talk about debt, we're just talking about the exchange of money. It's not the
So how does
exchange of good
that work?
services.
Because of that, you were able to get that iPad.
Yeah, but the iPad is irrelevant to this question. I owe the money. That's it. They only see numbers. They don't see the actual goods and services. This transaction is not goods and services. This transaction is purely currency. They owe me money. I own the money, and they gave me money. That's what they see, and that's the problem. That's why interest is bad, because there's no exchange of goods and services. It's just the exchange of money. And as we know, money by itself has no value. Money is only a tool to measure value of actual goods and services. So when people exchange money to make more money, that's why God has prohibited it, because he sees it as you trying to rip someone off, right? You try to tell him, give me money, and then I'll give you money, and then you have to give me my money back plus a little bit extra. And then obviously Austrian economists will say, hey, but the present value means that money that you paid him in the future is the same as the money that he lent you in the present. Well, that's only true if you factor in inflation, right? What if the economy doesn't have any inflation? Then the money that he's given you in the present is the same as the money that you're going to be giving him in the future. So that's that. Hope you guys enjoyed. We'll see you guys next episode. As always, stay safe.